All right. Good evening, everyone. Welcome to another episode of Jim and B Goal Getter Live. I am Andrew O'Connor, Manager Client Partnership at JMB. And for our regulars, I know you're probably wondering, hey, where is Kerry? But for this month, we're changing it up a little bit. So for September, we're having a special month, a special series, and it's going to be called Man Talk. So you're going to be meeting different male hosts from JMB. We're going to be covering different topics. So stick with us. So last week we discussed the role of a father, and we had a very lively and fun discussion. And for this week, we don't expect it to be any different. So stay tuned. If you're new, welcome. We meet here every Tuesday to talk about finances and other lifestyle issues affecting you. Sorry. So a little background. We started these webinars at the beginning of the pandemic, and the feedback that we got from you, our clients, has been great. So continue to share your feedback even for tonight. Put your comments down, and we'll try to get to as many of them as possible. And as we continue the series, everybody's going to be staying at home, so feel free to check out our other episodes on Facebook, YouTube, and LinkedIn. So tonight, what are we discussing? We're going to be talking about men's style of investing. What to look for when you're investing, what to avoid. How is it that we as men, we think differently from women, whether we want to accept it or agree with it or not. So we're going to be talking about how can you leverage that strength that you have, that inner strength, when it comes on to money. And we also want to share with you some things that you should avoid when investing. So tonight we have with us two special GMB team members who are going to be sharing with us on this topic, and I assure you, you do not want to miss it. I've worked with both these gentlemen at different times at GMB, and you know how country people say you're bright like morning star? Yeah, that would describe both of these gentlemen. So joining us tonight, we have our very own Peter Thompson, Group Client Investment Manager, and Greg Lindo, Assistant General Manager, Treasury and Trading. Now, at JMB, we tend to have a lot of acronyms and a lot of titles that, to the outside person, they're not so sure on it. So I'm going to invite now Greg to share with us and, to tell us a little bit about what he does at JMB.
Thanks, Andrew. Good night, everyone. So my name is Greg Lindo. I am the Assistant General Manager for Trading and Treasury at JMB. And my role is to pretty much guide the proprietary portfolios of JMB across fixed income, bonds, FX, and equities. I work alongside a team of traders that we manage both our JMB's portfolio as well as we trade on behalf of clients.
All right, thanks, Greg. And over to you, Peter. Let us know what it is that you do here at JMB.
All right, so what I do, I oversee a portfolio of investment managers. So all the clients' funds, so from a client investing in a unit trust, a pension fund, all of those portfolios are managed on behalf of clients by investment professionals at JMB. So I oversee that entire team. We also have client managers in Trinidad and in the Dominic. I oversee that entire strategy. So whenever the returns on the funds are excellent, I'm the guy you thank. When it is not, you talk to the person who I can tell you that they're responsible for it. So I oversee all investments for client portfolios at JMB, and the aim is to try and get the best returns for our clients.
All right, thanks for that, Peter. And we know exactly, how it is that at JMB we are really interested and we care about how it is that our clients achieve their goals. So thank you for helping us to do that. All right, so we're going to jump right in. We're going to start with you, Greg. Share with us, what does it mean to you when you use that phrase, investment style?
All right, so the investment style, I would say that is the method or the principles that a person uses to choose or how they invest their funds. And these principles may be influenced by a number of different factors. It could be based primarily on your personality. How do you stomach risk? How do you what asset classes do you personally like? And it could go from personal attributes to technical attributes, such as is want a certain stock with a certain growth objective or value objective. It really is, your style is encompassed by first your personality and then what principles you make to choose investment portfolio or investments for your portfolio.
Okay. All right. Yeah, man. Thanks for that, Greg. And just to kind of clarify some of the things, I heard you mention something like asset class. You can just clarify that for us, for some of the persons who that may be the first time they're hearing that phrase.
Yeah, sure. So, investments stretch across different asset classes. And by asset classes, you could have real estate, you could have equities, you could have bonds or fixed income securities, you could have money market instruments such as CD or treasury bills. And now you have all sorts of alternative asset classes, like you have cryptocurrency and all those different types of new investments that are now coming.
Okay. All right. Thanks for that. You mentioned, the investment style encompasses your principles, how you stomach risk and whatever goals it is that you want to achieve. So what are the different investment styles that, taking into consideration those variables that we would have that we can describe?
Well, it's pretty much unique to each person. A common way that we classify investors is the typical, either you're conservative, you're moderate, or you're aggressive. But the truth is that you have a number of investors that, they have their own unique way of doing or choosing investments. So some persons maybe actually be a blend. But it all goes back to how do you, or what is it your objective is, or how much risk you're willing to take primarily. But you do find a number of persons that they may find themselves managing their funds in a very conservative way, but they may actually tend to be more aggressive in certain other types of investments. So it really it's a unique attribute per person, I would say.
All right. Let's kind of put this in a more practical setting, Greg. So you mentioned that someone could have a blend of conservative and aggressive.
Mm-hmm.
All right. So kind of share with us what is your investment style. So you are seeing the things on the high level. Kind of share with us how you invest as an individual.
Sure. So I like to treat my portfolios based on my objectives. So for instance, I have a family, I have a young child and one on the way. So what I would try to do is to have an investment portfolio suited to whatever goal I may have for that aspect of my life. And that may mean being maybe a little bit more passive and putting investments in place for the long term. Whereas I may have another portfolio that I have of funds that I'm trying to maximize my return. And in that case, I'll be more aggressive. So I'll be looking at the market maybe on a daily basis, trying to, look at what is undervalued or what I think is undervalued, and maybe take aggressive positions in that to try and make the most or get the most bang for my dollar. I may also use leverage, which is actually borrowing funds to invest, depending on what the market gives me. So that, again, it goes back to what I said before. I don't think you can necessarily box in persons at all the time in terms of one type of investment style. It really depends on how your objective is and how you choose to go about meeting it, right? But in general, it's going to be different. So for me, as a person that's in the market and I've had a lot of experience trading the different markets, the way how I may go about it may be different from somebody that is maybe say not as experienced in financial markets, but maybe they have a business, because that's an investment as well. And the type of risk they take in that business may be greater than the risk that they may want to take, say, in an investment portfolio.
Okay. All right. And you know, one of the interesting things that I heard you mention is that, you know, you have some funds that you're going to be passive with, and then a next set of funds that you're going to be aggressive with, depending on the goals. And I think that's very important for us as investors to underscore that, hey, you're not going to put all your eggs in one basket, because persons kind of have the tendency to want to skew their portfolio or their funds to the highest or the biggest thing at the time, you know. So if it is that the stock market is growing, people will put short-term funds on the stock market because that is the big thing. So, you know, we really want to underscore that we want persons to have different goals and invest accordingly. So if you have a short-term goal, you put in your funds in short-term instruments and so on. So thanks for driving that home for us, Greg. Peter, over to you now. So based on the definition that Greg had shared, you know, in my time as an investment advisor, I used to get this question a lot. Persons want to know, what is the best investment? You know, they want the best stock, what is the best thing, you know, and really and truly, as Greg said, there's no one size fit all. But I'm still going to put that question to you because we have been getting it. What is the best investment style?
All right, the first answer to that question, and I think it's a common question as you pointed out, but the answer to that question is the best investment style is your investment style. As Greg pointed out, your investment style, just like how you have your style in terms of how you dress, is yours. I may look at a guy and say, you know, he's wearing colors that I would never ever wear, but that's his style. So for him, that's his style, and that's the one that fits him. So for me, the perfect way to actually meet your objective is unique. And you know, just to touch back on what Greg spoke about in terms of the investment style, you know, putting all the way you actually make a decision. Everyone wants to achieve some goal. They want more money. They want to put money down and have more at the end of the day. But how they actually go about that entire process, what they actually buy, what they put in their portfolio, or what are the things that they put their money on, it's critical. You have, again, to what Greg spoke about, you have people who, if I mention a bond to them, they're saying that's waste, you know, 6-7% on a bond. I can earn 20% by investing in, you know, in a car business, you know, flip it, turn it. That is actually investing. The style that you actually use is not, there's no perfect style. There's a style that fits you, and there's a style that's perfect for you. But what I want our viewers to also look at is that regardless of what your investment style is, you need to start. You need to have a plan around how you are going to actually achieve what you need to achieve.
Okay, so pretty much for someone to identify their own style, they would now have to be able to first identify their goals, and then to pretty much be able to understand, you know, what type of investments they would need to be in order to achieve those goals.
Yeah. To build on that, so you are trying to invest towards an objective. How you actually do it is you're going to look at what are the things that you can invest in and sleep at night. All right. The process of investing shouldn't be an uncomfortable one in which you're up worrying about the decision that you made. And that is why we have some people, they're putting their money all in a bank account, and all they're doing, you know, like that, and just putting money away every day, trying to build up a lump sum. Now, that may be a slow way of doing it, and I may look at it and say, okay, that's an inefficient way of doing investing. However, that investment strategy works for them in the sense that it's more comfortable. Our job as investment professionals is to actually help people understand what they're doing, are to show them different ways of achieving an objective. Get them comfortable to know that, okay, when I see the value of a stock fall, that doesn't mean that they're all of a sudden bankrupt or they're going out of business. That is the price of it on any given day. Now, when the price of something falls, you don't necessarily panic and try to actually sell it. That's the worst time to try and sell it. You wait. So that disciplined approach and educating our clients around how to actually make investments, giving them a wider array of information and options is what we are, looking to do. So once they're comfortable, once the clients are comfortable, then they will then apply their investment style, and their investment style will be a more informed investment style that's suited for them. And again, guided by an investment professional. And I don't want to leave out the guy who uses financial institutions. They use financial institutions as a means to an end. So I'm sure we have brothers on out there now that say, okay, 10% in the bank won't cut it. I'm going to buy a 2-car, rent it out, make a money, flip it, turn it 3 times for the month, and I'm better off than doing the old-fashioned way. That's his style. And your style, just like how your personality changes over time, will change. And so when you're a 25-year-old, the things you like, the cars you like, the women you like, all of that different than the ones that you like now. And I see Andrew looking and say, okay, yeah, I remember, what I used to do when I was, 23, and the person I'm married to now, yeah, you step up. So that's it. That's it, right? So your style changes, and once your style changes, it's important that you actually implement, that style. You follow through. You get education around how to actually invest, and then you have a plan towards how you actually implement your style.
Yeah, and I think it's very important too that persons are comfortable with what they're doing, and not just trying to do what everybody else is doing. Because as you rightfully say, one person can buy some taxis, put them on the road or whatever it is, and they can make that work. But that's not for me. So if I try it, it may not work. And that whole thing about sleeping at night, I've seen clients go into investments not because it suits them, but because it suits their friend, or as I mentioned earlier, it's the in thing. And as you said, the stock price change, and tomorrow morning you're getting a call, hey, what's happening with this stock? Or the bond price move, or you see some news, and they start panic and they're really uncomfortable. So it's really important that persons understand that, hey, the best investment style is my investment style. So thanks for driving that home for us, Peter. So far, we've been sharing some good information, and in preparing for this thing, we did some studies, and it shows that men invest a little bit different from women because men are more tolerant. So for the women that are on tonight, we'd like to hear from you. I can tell you from my personal experience, when I want to do something, the amount of questions my wife asks me before we can do an investment, sometimes at the end of it, I'm not even sure if we should really do it. So, women tend to want a little bit more information. So ladies, hit us up in the comments. Let's hear what you think. And I hope you're taking notes, because how men invest and how men think is a little bit different from you women. So share with us, let us hear what you're saying. I see someone saying that diversification is key. And Greg mentioned that earlier when he was talking about the different goals and the different type of investments. So thanks for sharing that. I think that Zadik is Scott. All right, so Peter, you mentioned about seeing somebody wearing some colors that you probably would never wear. So we know that everybody's style is different. And now that we have these younger persons, I think it's Gen X or Gen Y, I'm not even sure what they're calling them now, but their way of thinking or the way they view the world is totally different from, say, me or you or even our parents. So tell us, how is it that a Gen X person would invest differently from someone a bit older?
All right, no problem. So thanks. I think in terms of personality, investing style actually is in line with personality and the things that they that they view important. So there is a generation, I would say, the Gen X, you're in your 20s now. You are not used to waiting for things. There's a generation growing up that didn't understand that once upon a time TV used to sign off, right? So you get something and you want something and you're getting it now. So that translates also into their investment style. So when they look at an investment and they say, okay, I want to achieve a particular goal, they don't want it yesterday. They don't want it 2 days down the river. They want it now or yesterday. So that investment style for that younger person, it translates into more aggression in the sense of they're looking for aggressive investment to make a particular goal. That is different from people in my generation that kind of understand how life work. And it is, if it's too good to be true, probably more than likely it's not. So we are more diligent in terms of what we look at and more cautious. So as you change, as your profile changes, as you get more experience and you understand what, how investments work, I think your investment style change. So the Gen X generation or that young generation, their strategy, they're looking for the next hot thing. So you'll see when the stock market is up, everybody's buying stocks. When it's down, we look for the next thing. So currency is a thing. They're gonna find currency. So that hopping from investment to investment, it's not that it's bad. It's just that that's their cup of tea, and that's how they see getting towards an objective, the next hot thing. My generation, it has a little bit more discipline. I think when I started earning money, there was the hot thing around the time was currency trading 10% a month, right? And we all knew how that went, right? So coming out of that whole experience, we now appreciate, okay, investing is more of a slow and steady burn achieving your goal. The whole concept of diversification is, in the Jamaican landscape is technically new. And I say new in the sense that once upon a time, you could just put money down and earn money, as in risk-free. Put it on a repo, you earn 10%, 15, 20% per annum. That was magic. But then as markets change and things change, your style has to change in line with that. And do a concept of diversification. There's no free lunch. If you're getting 20%, you're taking some amount of risk to make that 20%. That's how it works. And as such, the older you get, the more you actually appreciate that, and appreciate that not all that glitters is gold, things can change, and as such, you need a plan. Now, for that Gen X guy coming up, I'm not saying don't buy, don't hop from investment to investment, but have a plan. Have a plan that doesn't rely on everything working out exactly as advertised. So the older folks, in my group, we actually appreciate that we've gotten our burns, we got our licks, so we understand that we need a more disciplined approach towards investing.
Yeah, and I think it's very important that we underscore that investing is not an overnight thing. Yeah, you will have some investments that can grow overnight or in a short period, but we really have to look at this in the long term. And that's one of the things that we here at JMB, we really pride ourselves in, is ensuring that we have these conversations with persons. So whether it is a Gen X or an older person, we really want to underscore what is it that you're looking to achieve, and how would you manage tomorrow if, as you said, Peter, things don't work out exactly the way you envision it. So it's very important that we have those conversations. And so far we've been having a lot of agreements with what you were saying, Peter. A lot of persons saying that they agree with what you're saying, that stocks are really for the long term. I heard somebody say true words. I saw someone also said yes, Peter, with exclamation mark. So persons are really engaged and following what it is that you're saying. Now for you, Greg, earlier we mentioned that men tend to take a little bit more risk than women. Kind of give us your thought on that, if it is that men are really more risk takers.
I can't really say that indefinitely, right? I see a lot of women becoming more involved, especially in like financial markets and starting their own business. So, I wouldn't want to say, okay, men point blank are more risk takers. Maybe the women may take more calculated risks. As I said, I can't tell you that for certain, but I do think that men on a whole, because of our, I guess, our position, if we're type A personality or aggressive persons, we want to kind of take control and make certain decisions to ensure that we're maximizing our dollar and we feel good about it and going into businesses to try and flip and make money. Because I don't know any man that going to say that they're not like make money, and fast money is even better, right? But certainly from a risk profile, I can't really say that men take more risk than women, because I have noticed, from my position where I happen to see and speak with, a lot of persons that want to build portfolios, and a lot of them are women, and a lot of them are willing to take risks. A lot of them are getting involved in the market and really seeking the knowledge to educate themselves before making their investment decisions. As for the men, I also see a lot of men are out there, doing their thing, trying to stay on top of the markets, and also being aggressive. But it goes back to what we were saying earlier. It's not really. I wouldn't look at it as a man versus woman. It's more, your personality and really what you can stomach. And the truth is, I am seeing women becoming more aggressive. And the good thing for the markets is that I'm seeing overall engagement in like financial literacy. Trying to learn more about markets increase across the board. So that is good for both men and women, right? So that's pretty much how I see it at this point, right? It's not a man, taking more risk than woman. It's more, I'm seeing persons becoming more engaged around money matters, trying to educate themselves and trying to take advantage of the different opportunities that may present itself, whether it be in starting a small business, or whether it is trading in the stock market, or coming in to purchase unit trusts, or set up long-term investments for their families. I mean, that's pretty much why I'm seeing it right now.
All right, thanks for that, Greg. And it's really important for us as investors, because even though we are investment advisors, we still have funds to invest, that we try and ensure that we can get our hands on as much information as possible. Because even when you go to the doctor and the doctor gives you a prescription for something, you still have some people who will go home and Google it to say, hey, what are the side effects of this, and why they do that? Because even though we trust the doctor, we still want to know as much as we can on these things. So as investors, it's very important that we don't just lean on our investment advisors or an investment company, but we take that initiative and try to get that information for ourselves, because of course that will help us to make very good decisions for our own portfolios. And when you mentioned the not man versus woman, is really about risk profile and risk appetite. Those are two things that we talk about a lot when we're talking about investing and creating your portfolio, and the different type of assets that you put in. We even mentioned earlier about people not being able to sleep at night. So Peter, I'll put this one to you. How would you describe, or what is risk appetite, and why is it important to an investor to understand what risk appetite is?
All right. So when we look at risk, the risk appetite is actually a psychological phenomenon, right? And it has two forms. It has, or it's made up of two things: your willingness to take risk and your ability to take risk. Now, the willingness is a huge psychological part of it, and Greg was mentioning the difference between men and women in terms of their investment style, or in terms of their approach and their level of aggression in investment. I would say women are more calculated, as in they're looking way down the line. What if this happened? How will that work? Rather than they're really just afraid. So a risk appetite is made up of both your willingness to take on risk and your ability. Now, the willingness part, as we say, is how do I feel when I make an investment and I see that the value of it falls? The willingness is that psychological element to say, okay, I am going to panic, I'm going to lose my head if I see this thing decrease in value. So that's a willingness. How much, how comfortable you are seeing things moving up and down. No, everybody wants to see it go up. You actually feel there's this psychological thing that you feel much better when things are going up. When it's going down, how do you feel? Are you the person that will then start thinking about the children not being able to eat, type of a thing? That's the psychological element. The ability part of it is really and truly, can you afford to lose your investment? Can you afford for this thing to actually be down 10% and stay down for the next 5 years? That's the ability. How much, what you're putting in your investment now, do you have the ability to lose it? And I thought you put both of them together to actually get an idea of your actual risk tolerance. Now, 9 out of 10 times, the willingness to take on risk will trump the ability to take risk. Another way, if you could have someone who is well off, for example, Andrew with the new Audi, right? He has the ability, he may have the ability to take on risk in that, okay, he's driving a very nice car, and as such, he'll have a nice house. He's not worrying about where his next meal is coming from. He comes into some money and he wants to invest. The ability, he could lose that money and still drive the Audi, right? The ability to take on risk, it's easy. He's fine with that. He can afford to lose it. The willingness to lose it now is where the problem is. Now, if he goes and say, okay, we're going to make a risky investment in which I can lose all of it. No, as he pointed out, that his wife is going to ask him, what going on? How can you be making this investment? So his willingness to take on the investment may prevent him from actually doing the investment, which again, it overcomes his ability to take on risk. And as such, so the psychological element of it always, overcomes the other elements of it. So for us as investment professionals, it is to kind of walk you through that whole concept. Say, all right, yeah, you're investing in something now, the value of it can fall, but it's not that you're going to put in the poorhouse. They set up your portfolio in a way to say that, yes, you just come into $100,000. So a guy walked into the office and said, he just come into $100,000 and he wanted to earn it. Now, to earn it is really taking on an investment in which the value can go up and down. That guy may not have the ability to take on the risk. He's gung-ho about it, he's excited about investing in stocks, but he may just not have the ability to take it, because if the value of the stock goes down, aka the guy who invested in stocks in, let's say, March 1 of 2020, nobody knew that there was going to be a global pandemic that shut down the world. Everything fell. So the person who had their first $100,000 and said, I want to turn it, put it in stocks, the value of the thing fall, then they're having trips to the bathroom type of a thing, because that's his one last $100,000 he puts in. For us at JMB, in terms of the approach and investment style that we're trying to, our investment discipline that we're trying to reinforce, is say, hey, you come in with $100,000, let's talk about whether or not this $100,000 is needed to pay the rent next week or next month. If so, this thing over here is not for you. This thing that you hear everybody talking about and getting excited about, it is not for you. Don't look on this side because you don't have the ability to take on this level of risk. We are trying to protect you from yourself. Of course, he's gonna say, okay, no, I'm a big man, he can do his thing. We always we advise him, but at the end of the day, the big man take his own risk. Now, when it falls or if it falls, then he's gonna get nervous. So the approach, the investment style, within the education, we hope will help people make better investment decisions. But willingness and ability, it's hard to actually try and model that. We can tell whether or not you have the ability to take it, but the willingness to take on risk is where it gets tricky. And so to find that nice little balance, only you can answer that. We can tell you about the willingness, the ability, but the willingness part is where you, as an individual, and your whole upbringing, right down to your DNA, that is embedded in you.
Yeah, it's very important, Peter, to try and balance the willingness and the ability, because a lot of persons, the willingness is so much stronger than the ability. It kind of clouds the investment decisions that are taken, So as investment advisors, it's really important that we try and balance it. It's a difficult balance because, as you said, the psychological aspect of the willingness sometimes supersedes the ability. And that example when you spoke about the person with the last 100,000, I cannot tell how many times we've seen persons invest funds in things that really they shouldn't be investing in, because at the time the willingness was there. I was like, yeah, man, I understand that this thing can fall, and you tell me that it can fall, and I agree that it can fall, but I don't think it's going to fall. So let me put this here. They put this here, and then inevitably what we told them could or was likely to happen has now happened, and they're left in a situation where that money was really supposed to be used for something else, and persons are in a position that they really shouldn't have been in the instance. So
Andrew, before you go on, so let me put you into some trouble. No, 9 out of 10 times are those persons who are asking for that, men or women?
What we have seen is kind of a mixture, so a kind of Android side. It's not just men. I see a comment that says, I think men are more risk averse. Thanks for that comment, Angela Shandaya. But I really think it is. I'm actually making a little note here, Peter, and I think we're suffering from a very strong, let's use stocks now, a very strong performance over the last couple of years. So persons who are new to investing, let's say that Gen X that you mentioned earlier, they haven't seen fall off in prices, because since they have started to educate themselves and read on the market, everything has just been going up. And if it's one thing that I know you have always driven that home with us, is that nothing goes up forever. Similarly, nothing goes down forever. So you really have to put yourself in a position where you can kind of get the best of both worlds. I see Greg he wants to weigh in on this.
Yeah, I agree. It's all about timing and setting the right expectation. You have to be realistic, and the truth is, for some persons that have been in the market for a longer period of time, or whether it is running a business, investing, their outlook may be a little bit different compared to persons that may have started in the last couple of years, which I call it years of quantitative easing, where interest rates are just super low, and it may cause persons to have this confidence that you may have done some good investing, and you may have made, I hope you would have made some money, but then we're in a different environment now with Mr. COVID, right? And maybe a person who had that risk, that ability and willingness, and was actually doing well, may not necessarily feel the same way at this current time.
Yeah, and that still just drives down the point about diversity, because once it is that you have diversified your funds, when your ability changes or your willingness changes, you should still be in a position to be able to achieve your goals. And you mentioned something, Greg. So as a trader, you spoke about timing. Share with us what you would say to someone who wants to jump into the market, pretty much when everything is climbing, when things are looking good. Tell me what you would say to someone like that.
Well, I think it was Warren Buffett that said, be greedy when others are fearful, and be fearful when others are greedy. And by that, I mean, in a time where the market is going up and everybody is buying in, you have to take a strong look at what your investment style is, what's your philosophy, right? What do you look for in an investment, and focus on that rather than being a part of the herd, right? So certainly you'll have markets that are being influenced based off of many different things, but at the end of the day, before you make that decision to put your hard earned dollars into an investment, at least have some set of rules or principles that you use to ensure that your decision is based in some facts, not necessarily, oh, the market is up, I need to get into the market. No, you know while that may work, and it may have worked for some persons, as you had mentioned before, nothing goes up forever. So at the end of the day, whatever decision you make to invest has to be coming from a place of sound principles.
All right, so I think we all agree that this whole thing of taking risk is really an individual situation. But I just want to share with you, we asked this question out in Twitter land yesterday, and 47% of respondents figures that men are always more risky. 5% said men are never more risky than women. So Peter, let me pose this one to you. Since it is kind of, let's just accept the polls. What should men look for when it comes down to their finances when they're trying to look at an opportunity? If it is that we accept that we are generally more riskier than women.
All right. So my fundamental philosophy with any investment or any decision making that I have to do, I think it through. So yeah, I think the whole conversation around men being more risky is along the lines of men are more quick to make a decision because they're driven by we are driven by a lot of testosterone, right? So it is for us to sit back and actually think it through. What is the objective that I'm trying to achieve? The minute you decide, okay, I'm trying to achieve a particular objective, it's then to actually know as much as possible about it. And then secondly, actually get some form of help. I've always said it. Men refuse to go to the doctor, right? And we refuse to go to the doctor because we can't tough it up. When it comes down to investment, men also believe, we believe that we know more and we are trying to do our best. We do a little research, or Bridget tell us about it, and we say, all right, we're jumping. Of course, the woman in your life will say, okay, think about it some more and do that. So right now, in terms of making an investment decision, the strategy around it are all the time. It's actually know what you're getting into. If it is that it's not your area, get help. Don't be afraid to come to the financial doctor. Talk to the doctors. What are they saying? They may know, or we may not be experts in the sense that we don't know the future, but we have more experience in doing it than you. As in, this is what we do every day. So talk to an investment advisor. Talk to people who are in the business and actually get some form of advice. The next time we actually think it through and you buy a particular asset, you know what to expect from it. So if it goes down, you're not surprised because you're focused on some long-term investment. You know exactly why you bought it in, you know the ups and the down, you know which area in your portfolio this asset actually plays a part. What the earth also says with men are always, or people in general, and this is what I like about Jamaicans, we're always looking at alternatives and creative ways of how to actually turn money, turn things into money, or opportunities into money. If you have a talent, that talent can be part of your investment portfolio. That's what we call the human capital in your portfolio. You have this talent, utilize it in your portfolio to make more money. Yes, your 9 to 5 is going to give you X amount of income. You can then allocate X amount of it to a bank account, X amount to an investment in bonds and stocks. But then, you know, as men, we know, you know how to fix car, or you know how to set up Wi-Fi network for people. Utilize that in your investment portfolio. Invest, you know, you spend time and energy learning that craft, you know, get a return on investment on that opportunity. So to summarize, when you're analyzing or looking to make an investment, know more about it, get help or advice and think about the investment. Don't think about it in the sense that this is going to work out exactly like where I think it will. What if it doesn't? Think about the different permutation. Also balance your portfolio. Diversify your portfolio. We don't see anybody who has gotten rich by just putting all their eggs in one basket. Tesla, Elon Musk rich? No, he doesn't have one electric car. Even Elon Musk is diversifying, doing a lot of SpaceX thing. He was in solar. So if you think about it and say, okay, I'm going to invest and I'm going to do one thing I'm going to put one thing in my portfolio and become rich, the odds are against you. That is the thing that will, make you rich. Diversification always make a whole lot of sense. And once you're making this investment decision from an informed perspective, using all the possible information that you have at hand and getting expert advice when needed, then you're much better off than running head on in and say, okay, my friend made some money, I'm gonna try and make some money too.
Yeah, and one of the things with diversification is that it allows us to not just to spread everything out, it spreads out the risk as well, which is one of the things that a lot of people kind of shy away from, because when you have an investment that is probably giving you 20%, as you mentioned, they want to put all the funds on that 20%. And understandably so, you want to get the best bang for your buck. But what is important is you're giving up some amount of risk for that 20%. Do you think, or can you really and truly put all your eggs over there? Because as you said, if the basket drop and all the eggs broke, for some people, them can always go and pick up some more eggs. For some people, as we say here in Jamaica, dog name your supper. So we want to ensure that our clients they understand that. And that's one of the things that we preach as much as is possible, diversification. I know, Peter, you mentioned earlier about unit trusts, and that's some of the funds that you manage. So kind of tell us how unit trusts fit into that whole thing of diversification.
Oh yeah, excellent. All right, so a unit trust is the broad term for it now is collective investment scheme, where we take the money of Mary, Tom, John, Brown, and Sue and put it together in a pile, and we manage that money on behalf of all of the people who put money in the trust. So the investors in the trust, all the clients, are unit holders, so they own the investment. So we make investments on their behalf, buying stocks, bonds, and all of that. The beauty about a unit trust is that it allows you to be diversified with a small amount of money. That puts it a different way. So when you buy, for example, a unit trust that is invested in stocks, right now the unit trust stock portfolio has probably around 25 stocks, right? So by putting in your $10,000, with only $10,000, you're getting exposure to 25 stocks. You're getting that diversification automatically with that small amount of money. If you tried getting that diversification without a unit trust, that would mean that you would have to spend significant more amount of money than $10,000 to get exposure to 25 stocks. A unit trust also is actively managed, meaning there's somebody sitting down every day watching it and say, okay, I saw Carrera stock price drop. Should we buy more? Should we buy less? We have people looking at everything associated with all of the companies that we buy. So when you buy a company, you own a piece of that company, or when you buy a stock, you own a piece of that company. So you should be monitoring that company to make sure that it is performing the way you expect, so you can know when to come out of that company. Or when you see a stock price fall, you know that, hey, things will be fine. It's people just panicking right now, so hold strain. So in the portfolio, you have people in the background managing it. So a unit trust, for example, in stock, gives you automatic diversification. It gives you active management, and it offers you a structured investment style towards getting towards a particular goal. Now, we even go one further, Andrew. So rather than just say, okay, put all your money in one unit trust, what we say is that, hey, come and talk to a big man. So what is it that you want to do? You want to send your kids to school in 5-10 years. Not only will we put you in stocks, we'll put you in bonds, we'll put you in foreign currency bonds, we'll put you in real estate. So we'll build your portfolio. Now, if you are trying to do that with a lot of money, well, if you're trying to get that diversification, you need a lot of money. But through a unit trust or through a portfolio of unit trusts, we can give it that exposure. So we put some real estate unit trust in your portfolio, we put some stock unit trust in your portfolio, some bonds, some foreign currency one, a nice big pie. So you're diversified across stocks, you're diversified across bonds and real estate portfolio. So an excellent way to get us to invest in a manner that is structured and diversified and actively managed.
All right, thanks, Peter. That is a lot of information right there. So we'll of course invite our viewers to join us or to reach out to an investment advisor so you can get more information on that and then get your portfolio on way if you haven't already done so. Greg, a question for you. Now, we just spoke about, or we just heard Peter talk about the stocks, the bonds, the US investments, and so on. So share with us what type of investment opportunities are available now. So even though we're in the middle of a pandemic, we know that there are always opportunities. So share some of those with us.
Yes, that's very true. I mean, despite the challenging times that we're in to COVID, there's always opportunities. There's always a light at the end of the tunnel. However, we may not be seeing it quite just yet, right? But I mean, I see potential across a number of different asset classes. As I had mentioned earlier, I have quite a few these days. But starting from the areas that we're probably the closest to is, I mean, the stock market, right? So yes, we're in a bad situation with regards to the economy and expected contraction, and you hear it's 10%, and then the measures to limit movement may actually mean it's worse than that. We don't know. So we're still in a period of high uncertainty. However, at some point in time, things will turn. Things will improve. And if you look at the market now, there are maybe some opportunities, some companies that you would have wanted to buy, say, late last year, that now you're looking at maybe a 40-50% discount on the price. No, it doesn't mean that some of these stocks are going to go back to the same price in a week or a month. It may take a year, 2 years, 3 years, who knows. But for the persons that have the risk tolerance, or going back to what you were saying earlier, the ability, right, and willingness to take the risk, now may be a good time to look at some equity investments. Similarly with bonds, bonds have, they have a place in your portfolio because they provide a very stable source of income. Now, of course, that may depend on what kind of bond you choose. If that bond if it's a corporate bond, a sovereign bond, but there are opportunities in the space to buy good names to get above average yields, just because there's this massive risk aversion, or persons just not wanting to participate in the market at this time. If you're interested in real estate, I mean, the Jamaican real estate market has been on fire, and while we really haven't seen it slow down per se, there is going to be opportunities in the real estate market. Interest rates remain low. Despite all that's happening, it's still a pretty good time to look at getting yourself qualified to make real estate investments. And certainly that is a long-term play. Real estate does tend to outperform equities and bonds over the long term. So certainly that is an opportunity for persons to explore as well. It's difficult for me to tell you, okay, I see, a specific play per se, because it really depends on what is your willingness to take risk. So whereas, if I could have access to infinite dollars, there are certain specific plays that I'd make right now and just maybe lock my eye for the next 5 years and not worry about it. That's not the situation for most persons. So again, it goes back to whatever principle you have in terms of making your investment decisions and then applying that to each opportunity. So hey, a lot of persons were buying Airbnb, buying apartments for Airbnb. That doesn't appear to be working out that well, no. But at the same time, it will recover at some point. You look at, say, maybe an attractively priced property or land, do something maybe down the road, or is it that, hey, I need to take an opportunity in bonds? No, or is it that I need to start a business? Because it's not just about financial markets. I mean, COVID has created a number of opportunities for entrepreneurs now to take advantage of. We see it in terms of some persons launching food delivery services, or doing different innovative things to satisfy the market. We are in a new paradigm where we are in a new normal, and the opportunities extend far beyond just bonds, equities, real estate. I mean, a lot of persons are getting involved in businesses, and that is something that I definitely encourage, because it is going to definitely play a large role in terms of economic recovery. So we want to see persons really not just confining themselves to maybe some are just the traditional opportunities, because those opportunities are there for the taking as well, but to also expand your scope now to say beyond where you can also make an impact in, maybe in terms of entrepreneurship, or trying something else, trying something new, trying something different.
Okay. All right. Thanks, Greg. And it's very important that you spoke about things outside of just your stocks, your bonds. And one of the things here at JMB that we really pride ourselves in is finding out what the goals of our clients are. Because the goal that you have is really the base for any financial decision that you're going to take on. And we have been helping clients and partnering with them to achieve their goals. And I can share with you, when I help a client to achieve a goal, especially one that they never thought was possible, that feeling is so rewarding. And that's one of the things that we were built on. to ensure that we can help the average person to get a bigger piece of this investment landscape that we're in. And so we don't want the men. So gentlemen, man and man, brethren, we don't want you guys out there taking risk and making decisions on your own. So reach out to an investment advisor, have a discussion, and we'll help you along the way. So Pete and Greg, any final thoughts you'd like to share?
Well, for me, it's related to the approach that men as men, we always want to be seen as we're getting it right all the time, and we can do it on our own, and we're good at what we are and asking for help is normally not as strong, but it's much easier that in terms of making a decision, we talk about it, talk to somebody in the field, bounce your ideas with different persons. So my final say on the issue is that, yeah, men and women in terms of our approach, we are all the same in terms of we have the same objectives financially in terms of everybody want more money. And we all have goals, but the goals, how we actually get to the goals, that process to get towards the goals, I think is that where men do it different than women. And what I'm saying in terms of that process, there is a style that is unique to everybody, but there's a process that we've known and we've seen that work time and time again in terms of a disciplined approach towards investing. Always outperform this, replacing the next hot item or hot stock. So in this environment, there is an investment style that says, okay, we're only looking at things that beat up and are being sold at prices that people believe that the world will come to an end type of a thing. That style, you could be saying, okay, I'm buying those things. There, a long-term play is if you bet and say, okay, this is not the thing that will, end mankind as we know it, then there are opportunities out there to say, all right, what is that? People are selling that thing because they believe it will never, ever come back. That's a strategy. But how you actually execute that strategy, how much money you use to execute that strategy is where a financial advisor come in and help. There's a process around it such that if it doesn't come back 1 or 2 years from now, you're still fine. So I would encourage all of the men to say, here, I'm going to be me. I'm going to do what I need to do, but I'm going to seek counsel, and you'll get some brownie points if you also talk to the woman in your life about it.
All right, thanks for that, Peter. I don't know. It sounds like you're talking a lot from experience as it relates to. All right.
I've been at it a little while.
Sorry, say it again.
No, I've said I've been at it for a while. I have the ring to show it.
All right, cool. Greg, any last words from you?
Yeah. So in this time, stay true to yourself. There's a lot of things happening out there in the investment world, and self-awareness is key. You don't want to be in a situation where you take a trade or you make an investment and you can't sleep at night. That's not something I would wish on anybody. So there's a number of repositories of information out there. JMB, we are here to support you in making investment decisions. We put out a lot of information. Please feel free to call us, have a conversation. So, even if it is for us to just guide you, because at the end of the day, you will know what is best for you. Nobody can tell you what is, the best thing for you other than yourself. So reach out. Information is there, and don't be afraid. Stay invested. Yes, it's a challenging time, and there's a lot of uncertainty, but I can't stress how important it is to stay invested in the market, stay invested in your business, and just ride it out. Things will get better, and don't be afraid. Be courageous in this time.
All right, thanks, Greg. All right, so the feedback that we've been getting on our various platforms, Facebook, YouTube, has been very positive. I'm sorry, guys, that we didn't get to everything, but all of that just comes to show that this has been a very interesting topic and a very interesting discussion that we've had. And earlier when we started, I promised you a very informative session. And thank you, Greg and Peter, for delivering on that promise. You guys cashed the check that I wrote. So thank you very much. Thanks for taking the time to share with us tonight, some of the things that we as men need to look forward to or look out for when doing our investments. And we also want to thank you, our audience, for joining us tonight. Thank you for being engaged. Thank you for all the comments. And remember that every week, every Tuesday for the month of September, we're going to be talking about is Man Talk, because Monday, right? So we're going to be covering different topics that are important to men. And stay tuned to our platforms, Facebook, YouTube, LinkedIn, and Instagram, to find out what our topic will be for next week. And as usual, stay tuned to JMB. As your financial partner, we have your best interest at heart, and we want you to continue to stay safe. There's a lot of protocols going around now, but it's easy to remember the 3 W's: wear your mask, wash your hands, watch your distance, and of course, the last one, not a W, but 10 yard. So I'm Andrew O'Connor. Good night. Thanks again for joining, and have a wonderful evening.
Thanks, everyone.
All right, then. Thanks.